All right, let's talk about a real giant in the cybersecurity world, Palo Alto Networks. This is one of those companies that has Wall Street completely split, and it presents a classic dilemma for any investor. So we're going to break it all down.
And this right here, this is the heart of the puzzle. You've got a company that is, without a doubt, a world-class leader in an industry that's more important than ever. But, and it's a big but, the stock comes with a seriously hefty price tag. So the question we really have to ask is, does the quality actually justify paying that premium?
So what do these guys actually do? Well, they're not just selling you one-off bits of software. No, they provide these massive, interconnected security platforms for some of the biggest companies on the planet. I mean, think of it like the entire high-tech security system for a modern business. It protects everything from their cloud servers to their internal networks, and it's all powered by some pretty slick AI. Okay, let's kick things off with the bull case. These are the powerful, numbers-driven reasons why so many investors are just incredibly optimistic about this company. And trust me, the metrics here really do tell a compelling story. First up, let's just talk about the sheer scale we're dealing with. The company is on pace to pull in around $9.2 billion in revenue for fiscal 2025. And it's not like they're slowing down either. They're still growing at a solid 15% year over year. This is a massive, expanding powerhouse, not some little startup. Now, this is where it gets really, really interesting, because this gives us a peek into the future. That 15% revenue growth, that's great, but look at the forward-looking numbers. Their next-gen security recurring revenue is rocketing up by 34%, and their remaining performance obligations, which is basically future sales that are already locked in, that's up around 20%. This is a huge signal that demand is actually accelerating. And get this isn't just growth for the sake of growth. The company is an absolute cash-generating machine. We're talking about a free cash flow margin of around 38%. Now, to put that into perspective for you, almost no software companies of this size can turn that much of their revenue straight into cash. It's just incredibly profitable.
And you know, this kind of performance, it doesn't go unnoticed. The professional analyst community, the folks on Wall Street, are overwhelmingly positive. You've got about 40 analysts slapping a buy rating on the stock. The consensus is pretty clear. Even at today's price, they think there's still plenty of room to run. All right, but it can't all be sunshine and roses, right? Let's flip the coin over. Every great story has a but. And for Palo Alto Networks, the whole bear case really boils down to one thing: the incredibly steep price of perfection. And this slide just lays it out perfectly. This is the core risk. The company's price-to-earnings ratio, a key way to measure how expensive a stock is sitting around 125. The broader market, it trades at a multiple of maybe 20, 25. So you are paying a dramatic, like 5 times premium for this stock compared to the average company out there. So what does a price tag like that mean in the real world? It means the stock is priced for absolute, flawless execution. Any tiny disappointment, a slight miss on revenue, guidance that's even a little bit weaker than hoped for, can send the stock price tumbling. There is just zero room for error. And let's not forget, this company is not operating in a bubble. The cybersecurity space is a total battlefield. You've got the old guard, the huge incumbents like Cisco and Fortinet, and then you've got these super agile, fast-moving disruptors like CrowdStrike and Zscaler. All this competition creates constant pressure on prices and means they have to innovate like crazy just to stay on top. Which, leads us to the ultimate risk here. The whole reason you'd pay that premium price is because you believe that PANW will always be the best-in-class go-to choice for customers. But in a field that changes this fast, can they really hold on to that top spot forever? That is a very, very high bar to clear. So, okay, we've laid out the bull case, we've laid out the big risks. What are you supposed to do with all this? Well, let's bring it back to what actually matters, whether this fits into your personal investment plan.
Let's just put these two side by side. It makes the trade-offs crystal clear. With PANW, you're getting a laser-focused bet on cybersecurity, but that focus comes with high volatility and that sky-high valuation. On the other hand, a broad ETF gives you diversification and more stability, but you're not getting that targeted growth. These are just two fundamentally different ways to invest. So who should be thinking about buying a stock like this? Well, it might be for you if you specifically want to bet on the long-term growth of cybersecurity. It's for you if you've got the stomach to handle some pretty big price swings,
And you have to be a believer in the idea that paying up for a high-quality, super profitable business is worth it.
Now, on the flip side, who might want to hit the pause button? You probably want to wait if you're a value investor who's always hunting for a bargain. Or if your portfolio is already jam-packed with tech stocks, maybe you don't need more. And if the idea of seeing your stock drop 30 or 40%, even if the company is doing fine, makes you queasy, then this probably isn't the right fit for you.
And really, that brings us to the final, critical question you have to answer for yourself. In the world of investing, is paying that premium for quality, for a market leader, a winning strategy in the long run? Or is it just an unnecessary risk when there are cheaper options out there? The right call on Palo Alto Networks really depends on your answer to that fundamental question.